So, Scott, yesterday in our editorial meeting, we were discussing this Bed Bath and Beyond news, and you described a trade that you'd made on the stock on BBBY, a pretty big trade. You actually have $900,000 on the line. So we obviously found this fascinating, and I think our listeners would be interested in both the mechanics of this trade and your rationale.
I wrote 4,000 contracts or sold 4,000 put contracts, which is the equivalent of a put agreement on 400,000 shares with a strike price of 250 expiring Friday at 4.
So let me just unpack that. A put is a kind of option. It gives
Mm-hmm.
the buyer of the put the option to sell you shares of Bed Bath and Beyond at $2.50 at any point during a given time frame. In this case, the time frame was what you set, 4 days. In exchange for that option, the buyer paid you 25 cents per share. Now, the buyer is betting that the stock is going to drop below $2.50 because if it does, they can buy the stock at the lower market price and immediately sell it to you for 250, i.e., they win. If it stays above 250, though, the put simply expires and they'll lose because they paid you 25 cents per share on that option for basically nothing. Each contract is an option on 100 shares. So at 25 cents per share, you sold each contract for $25, and for 4,000 contracts, that means you were paid $100,000. The risk, though, is that if the stock goes below 250, you will have to honor the contract and buy it at 250. So if the stock goes to, say, 225, you'll break even. You made 25 cents per share when you sold the puts, but now you're going to lose 25 cents per share when you buy them back. If the stock goes to zero, which isn't likely, but it's your worst case scenario, you have to buy 4,000 worthless shares for $2.50, which costs you $1 million. And that's against the 100,000 that you made when you sold the puts. So that's a net loss of $900,000. Do I have that right?
That's exactly right.
Okay. So one more thing before we talk about your rationale here. There's some lingo that can make this confusing. Strike price, that's a term people might be familiar with. That's the price that the put buyer has the option to sell at. In your case, that was $2.50. Then there's the premium, and that's the amount that you actually sold the put for in the first place. It was 25 cents per share, but that's not something you get to decide. That's set by the market, just like the price of a stock. And finally, these were put options. The other kind of option is a call option. That's an option to buy a stock from you instead of sell it to you. Otherwise, it works the same as a put. Someone buys a call option if they think a stock is going to go up, because if it does, they can exercise the option at the strike price and then immediately sell it at the higher market price. Okay, that was a lot.
Mm-hmm.
Scott, the question here is, why did you do this?
So I never traded options before, and I started doing it as a hedging strategy. When stocks were really high a couple of years ago, and I thought meme stocks were just ridiculous, I started writing calls. There's a psychology effect here that I think benefits someone who writes options. Now, what is that? The majority of the new money into the market is young retail investors who I would loosely describe as stupid. And that is one, they're looking to get rich quick, and two, they have no perspective of time. They don't realize how quickly time goes. So what does that mean? They want to buy call options. They want to get rich quick, and they don't realize that if they buy an option that expires in 30 days, that 30 days is going to go much faster than they think. In addition, the people who are writing the options, there aren't that many of them. One, you have to have a decent amount of wealth because whoever is your broker will do a scenario, worst case scenario, and say you would have to come up with that money. So in this case, my broker, Goldman Sachs, says you could lose $900,000. Do you have it? Because we're going to have to honor this contract. So we need to make sure you have it. So that limits the number of people who can write contracts. And also the institutions with the deep pockets, a lot of them, especially hedge funds, have it in their investment documents that they're not allowed to write options because of the volatility. So I like the asymmetry here. Where you make money is when there is an imbalance in buyers and sellers. When there's nobody who wants to buy condos in Miami in 2010, that's when you want to buy. When everybody wants to buy beachfront real estate in Palm Beach, that's when you want to sell. When there's an asymmetry between buyers and sellers. I believe there is an asymmetry between the people who want to buy options and the people who want to sell them or write them. Now, what I do is once a week, I look at the most volatile stocks. Because if you're going to buy an option, you're believing it's going to move substantially because there's certain premium you have to pay for time value. So if you're writing an option, you just want nothing to happen. You just want time decay to take value down, if you will. So the most volatile stocks require that whoever's buying the call or the put have to pay more to the person who is writing the call or the put. So when I saw
Mm.
that Bed Bath & Beyond plunged 45% because it looked like it was hurtling towards bankruptcy, I thought two things. One, it takes longer than people think for this to play out, even if it's on its way to bankruptcy. The stock on Tuesday was trading at $2.62, and I could get 25 cents for writing a put that expired on Friday at a strike of 250, meaning that if it did not go down by 15% by Friday, I make money. If it stays the same, I make all the premium. If it goes up, I make all the premium. If it goes down 12 cents, it's still above 250, I make all the premium. If it goes down to 225, I still make money until 225 and then I break even. It could go all the way to zero, right? And then I could potentially lose on 400,000 shares, 225, $900,000. People want to avoid pain so much. It's a basic human attribute that they avoid things like this. So I think it's what I call a good trade on a risk-adjusted basis. So I go out, I write the put because I believe the likelihood of the stock going down 15% in the next 72 hours is less than people think. And I'm going to get good premium because to find people willing to write a put on a stock like this that is so volatile and has so much negative news, they have to pay me a lot. Now, having said that, you can get hurt really badly. A couple of things. I do this every week. I do it for 1 week terms. You get more of a premium for short term. And I do it directionally against stocks that I think are usually going down. So I usually write calls. And I usually use it as a means of hedging my long positions. I only do it. Two key things here. One, don't try this at home. Unless you have substantial capital, you probably can't do this, but B, you don't want to. And two, I don't spend more than 30 minutes a week on the phone or examining this or looking at this. I don't want to spend a lot of time thinking about this. Every Friday afternoon towards the close of the market, I talk to my broker. I look at the most volatile stocks, and I usually write calls. Sometimes I write, in this case, puts. And I did this on Tuesday when I saw so much action and so much movement. But what you want to do is you want to model a scenario. If you decide to do this, where the stock goes to zero if you wrote puts, or it triples or quadruples if you write calls. Technically, your losses are unlimited. Your potential for losses are unlimited on calls because technically it can go to $1 million a share. So you have to model out a black swan event and assume a black swan event and assume, okay, it's okay to be bummed, but it shouldn't change your life. And I model those things. So losing $900,000 is my maximum out of pocket. And that would be a bad day for me, but it wouldn't change my life in any way. And I find I'm disciplined about this. I do it across 2 or 3 stocks every week. And generally speaking, despite some very ugly weeks that really give you some indigestion, I've been writing calls or shorting Truth Social for a long time. You think, wow, Scott, you've made a lot of money. Yeah, over the long term. But in 1 week, when I wrote calls against Truth Social, it went from 50 to 95. And I had to write a really big fucking mushroom chocolate layered check for that person who showed up and said, okay, I get to buy, you have to go buy these and I get to buy them from you at $50. And I think I got maybe $3 or $4 in premium. Anyways, I find if you're disciplined in this market with a lot of new money into the market, a lot of volatility, and some flaws in our species, specifically a willingness to do anything to avoid pain, and 2, poor calibration of how fast time goes, I find this is a really good strategy. But again, this is not for the weary or for people who don't have strong stomachs. 2, do not spend a lot of time thinking about this. And 3, make small trades that even if they go horribly wrong, is not going to impact your life. But I made a trade. It's now Thursday at 262. I think the bankruptcy, if it happens, is going to take a lot more time to play out. And I think the volatility gives you incredible premium here. So I felt like this was an asymmetric trade that benefited the person willing to write the put.
Sort of a personal psychological question. When you lost all that money on Truth Social, did you tell anyone? Did you talk to your wife about it? Sort of, did you get it off of your chest in any way, or did you just sort of eat the loss and move on?
I'm transparent with people in my life about my wins and losses, but I aggregate them.
Mhm,
I won't talk about stuff in the moment, like, oh, I lost this day or I made this day. I find that people, generally speaking, talk a lot more about their losses. I remember my mom's friend. My mom lived in Vegas, and her friend was always talking about all the money she made in slot machines. And I'm like, well, she's omitting when she loses because over time, it's impossible to win in slots. I just don't care who you are. Um, so yeah, so I'll be very transparent. This year to date, I'm down. But I find that one of the things you have to do as investors is be very unemotional. I think this strategy works. So I'm doing this every week. And at some point, if I kept losing week after week after week, I'd have to stop for financial reasons. But I've been doing it every week for the last 3.5 years. And when I look at the whole year, even though I'll have some very ugly weeks, when I look at the whole year, the premiums have outweighed, sometimes significantly outweighed, what I've had to write checks for. So again, it's being unemotional, sticking to your strategy, trying to really ignore your emotions and your instincts because the market doesn't care about them. And your pain avoidance is so great that it'll influence your strategy. But I don't update anybody on my daily trades. And I
mhm,
try to, I don't want to say be psychopathic about it, but sociopathic about it. I think about it an hour a week when they come
mm,
due and when I want to renew them because you have financial capital and you want to put that at risk in smart ways. And I would argue, generally speaking, this strategy does not make sense for the majority of people out there. It's a way to hedge, it's a way to take advantage of volatility when you have a substantial asset base and can afford to take fairly dramatic hits and not have it affect you. I don't think it's the right strategy for someone your age, but it's an
mhm,
example of a market where you're tapping into what I think is a flaw in the species in terms from a psychological standpoint, and there's an asymmetry in the market here amongst buyers and sellers. But no, I'm
mhm.
not. I'm not updating anybody. I update people in my life, the key people who matter to me, about how we're doing long term and what
Mhm.
have you. But I don't come home and say, "Oh my God, I lost this,"
I
or "I
lost
made,
everything.
honey, it's champagne and cocaine for dinner." That's just not how I roll.
Do you have options positions in any other companies right now?
Yeah, I wrote it options. I wrote what's called a covered call option. So I wrote options exactly equivalent to my position in Airbnb. In my bigger holdings, I think of them as apartment complexes. And the way I collect rent is I sell out of the money calls. So even if, so say Airbnb is trading at 120, if you write an out of the money call at 130, if it goes to 135, you technically just gave up the upside because the underlying stock goes up. But if it doesn't go to 130, you collect a little bit of rent every month. And I've been doing that every week on my biggest holdings for the last 2.5 or 3 years. And that's worked out. It's called covered calls. That's not as risky. You technically give up some upside if the stock surges, but I generally think, okay, I'm going to write a call that's 3 or 5% out of the money. And if the stock doesn't go up 3 or 5%, I just collect the premium. Some weeks are tough. You're like, oh, it's a bummer to have missed out on the upside. But over time, I find if you're disciplined, you collect rent on that
Mm,
stock.
mm.
And I also, I'm sorry, last thing, the meme
Yeah,
stocks,
yeah.
AMC. Right now, I have a position in AMC. I wrote calls against that. Whenever there's a big move up in any of the meme stocks, I write calls against it. I think these things are just shitty businesses that occasionally Reddit and hormones among young people who don't understand the markets get excited about.
Okay, well, you'll have to tune in for next week's episode to see how Scott did on this
Yeah,
trade.
these are famous last words. These are.
Yeah,
This feels really uncomfortable, to be
I
honest.
kind of just want to check in on these trades every week now. We should create Scott's options section in this
Well,
podcast.
we had that. Someone made an anti-Galloway index because I made a
Yeah,
terrible call on Tesla. Most of the other ones I said were going down have gone down, but Tesla went up 700%. So the anti-Galloway ETF
that
was
well,
down.
that index is bullshit though. That has, just so everyone knows, that index basically emitted all of your wins. And it's just, I mean, Yeah, sorry,
Well,
that index just pisses me off.
since Tesla, even with its recent run up, has gone down 66%. I noticed the people tracking this index decided to stop tracking it because it didn't
Yeah,
fit their narrative.
yeah, exactly. And now,
Anyways,
it's been overtaken by the anti-Jim Cramer index, which is funny, but again, that guy's actually pretty smart and has actually made a lot of money and have made a lot of good trades. I mean, anyway, that whole meme movement pisses me off. But maybe I'm just protective of my boss. Anyway,
turn to mushroom chocolates. It'll help deal with that anger.